Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good afternoon. Welcome to MidCap Radar. I'm Samira Abdi, and with me is my colleague Anisha Jain. Hi, Anisha. Good afternoon. And well, not much that's good about the afternoon. So the key indices a bit in the red actually, but look at the way they've come off from the high point, now marginally lower, and that impact can be seen actually more in the mid-cap index. It's been lagging through the day, but as we speak now, it's a 1% cut, at about a 200-point cut actually on the mid-cap index, and not a whole lot doing well. And given that European markets have opened a tad on the front foot, they've shrugged off the trade worries, India remains a bit of an underperformer at the moment.
Well, yes, India definitely is an underperformer, because if you look at the Asian peers as well, they are trading higher with a gain of around 1%. But the Indian market, especially coming under a bit of pressure, especially the mid-cap space, and we can see that move in the rupee as well as crude. The crude has come back above the level of $79 per barrel, and rupee also, which had retraced from that level closer to 73 that we saw yesterday. But again, it has pulled back and reached a level of around 72, 78, and that's the reason perhaps we are seeing this move in the markets.
Let's invite Ashwani Gujral for a quick tech check now. Ashwani, good afternoon to you. So the selling pressure only continues. What do you do on the Nifty, and what are your individual trades?
So it looks very clear that sooner or later 11,250, which was recent lows for the Nifty, will get taken out, and this mild pullback that we have from the lows should be used to sell into the market, because today was a perfect day to engineer some sort of a pullback. And if we can't trade substantially higher even today, then it becomes very difficult, because the weak macros they continue to pressure the market lower. Today rupee had corrected in the morning, crude had corrected, but everything tends to reverse very quickly, and I don't think that we should be looking for very substantial pullbacks in the market, and at higher levels you should try to still sell into this market. And next 1.5 hours could be tricky, because any move on crude or rupee will lead to again a fresh round of fairly brutal selling. So Reliance Capital is a sell with a stop of 376, a target of 362. M&M Financial is a sell with a stop of 441, target of 425, and ONGC is a buy with a stop of 174, target of 187. Just one small point, that 1980 is the 200-day moving average on HDFC Bank, and instead of the value buying that people expect, it's moving further and further away on the downside from that. So these 200-day moving averages, and something has come off this much and that much, those sort of theories may not play out, because we are seeing selling at every lower level as well.
So Ashwani, you mentioned that there was 11,250, which was a support level, but if we break below that level, what could be the next level to watch out for?
See, that will be another 300 points lower.
Okay.
So basically 10,900, 950. The issues are very specific to us, so we can't really trade looking at the global cues, etc. And the CAD and EMs, they continue to bother us. And this 73 so far has been a resistance for the rupee, but slowly the dips are becoming shallower. So my sense would be that at some point 73 on the rupee will get crossed.
All right, Ashwani, thanks very much for joining in with your ideas. But it's time to head back to the JP Morgan India Investors Summit. And we have a guest joining in as well. Lata joins in to take us through this special conversation. Lata.
Well, we have a bonus. We have two guests, actually. We have with us Saurabh Kumar, who at JP Morgan covers a whole host of financial stocks, banks, non-banks, asset management companies, and even real estate. We also have with us, I believe, Harshvardhan Modi, who covers Asian banks. Gentlemen, thank you very much for taking time out of your busy conference and making time for us. Given the nature of the situation, we will have more questions for Saurabh, actually. Saurabh, first up, how worried are you about this heightened, costs that, that are going to affect AMCs, asset management companies? The expense ratios have to be brought down. will you have to lower your view on some of the AMCs you cover?
So, Lata, we'll have to see how much of this is actually passed on to distributors and how much is retained by the AMCs. But yes, over a period of time, we believe that the regulations in the space, especially relating to the total expense ratio, will be tightened. And there will have to be some claw down of profitability of the industry. I think the other issue with the regulators are also struggling with is the concentration issue, in which 5 to 6 AMCs control bulk of the AUM in the country, and obviously a lower TER does not help that case. So I think there has to be a balancing of that. But yes, in principle, the lowering of expense ratio would be a negative for the AMC, and we'll have to revisit some of the estimates based on how the industry reacts.
Yes, some of it could be passed on, but at the moment all those stocks are, or a couple of those stocks are struggling with about 7-8% cuts. Harsh, let me get you in to get the Asian perspective as well. Since you cover Indian banks, how much do you think there will be pressure on the Asian banks as well as Indian banks because of the rising cost of global capital and also rising yields in all these countries, including India?
Yeah, thanks, Lata. See, the key issue is this is more acute for the current account deficit emerging markets in Asia. And that's India, Philippines, Indonesia. That's where we have seen rate hikes way more than what a normal inflation would suggest. And that actually helps banks with deposit franchise and with some of the larger banks in all of these countries which are mostly deposit funded. It actually helps them to at a margin level. To the extent it impacts growth, it's not too much actually right now, because the underlying driver of growth is more related to liquidity availability, which is pretty straightforward. It's costlier, but the availability is not a problem. And you see that in the stock prices. Indian banks have actually held up much better compared to other EM, current account deficit markets. And a lot of the concerns are, I would say, reflected in some of the Southeast Asian banks compared to India.
Okay. Well, since you spoke about retail financed guys being better off, let me ask Saurabh about the wholesale financed guys, which is the non-bank finance companies. Saurabh, I have a slightly older report of yours where you're very confident about housing finance companies. But how worried are you about the sector in general, with the cost of capital, cost of funds rising almost 0.5% for them?
So yes, Radha, I think cost of funding is an issue. I think the bigger worry we have on the sector is essentially the seasoning on the books, because what we've seen over the last 2-3 years is a lot of companies have grown their books quite aggressively, and the normalized credit losses which one would expect in those segments are clearly not being reflected. So I think that's a bigger worry for us, and that's what we are essentially telling our clients, that you need to look at books which are seasoned, which have weathered at least a credit cycle, or at least if not two, and that's where we kind of look for stock picks. But so the unseasoned books in a rising rate scenario, especially when some of them are funded on CPs, I think that's an issue.
Well, I really wish you would mention the names of the companies, since it will require a bit of drill down for the retail investor to understand. Well, I guess Indiabulls Housing has not seen too many seasons, whereas HDFC would have seen a lot of seasons. That's the distinction, I guess, Saurabh is trying to make. But Saurabh, there is yet another problem now, other than seasoning. There is this sudden problem of asset liability mismatch. There were rumblings, but IL&FS has put it right in the center of the space. How have you analyzed the impact of IL&FS in terms of casualties?
So I think the immediate impact of IL&FS will obviously depend on if IL&FS is able to secure funding in turn, either from Government of India or from any alternate source. If that situation is not properly managed, then the second order impacts of that can be, in my view, fairly significant, especially on the wholesale financing guys, as the funding cost, especially for short-term paper, moves up.
Wholesale financing guys?
It could also have repercussions on... Yes, because of what happens with the money market and all.
Okay. Okay, so NBFCs can find, I mean, you think there can be a domino effect on NBFCs with one not being, even if one of them do not receive payments in time? Is that your fear?
I think the rates, basically the credit availability kind of could be an issue.
Okay.
And especially for some of the lower rated companies, and then there is obviously a network effect which plays out.
Oh, okay. What about banks itself? We were given to understand that of the 90,000 crore loan exposure of IL&FS, 60,000 crore is to banks, or probably 50,000 crore.
Yes.
Do you have a number, and will that be an additional NPA issue that has so far not been factored in?
So, Radha, I think the IL&FS thing is, from what we understand, was part of the watch list for some banks. In some banks, obviously, it's been classified as standard exposure. So we'll have to go bank by bank and kind of figure that out.
Okay.
But yes, it will be an additional slippage, definitely, on the books of many.
Okay.
If it were to slip. But from what we understand, there are a lot of assets which are still doing well within IL&FS. So, and some of the banks have said that they're confident of those exposures.
Okay. Let me get that question from Harsha as well. Harsha, what's your sense? I mean, would you worry about ALM mismatches generally in the NBFC space? Is that something you also track?
Well, yeah, see, any institution where funding cost is more wholesale, more driven by short-term movements, has a cost of fund impact. But the important thing to see, and this is across markets, not only in India, the important thing is to understand what is the asset side. If the NBFC is able to pass on substantially all of the cost pickup, if the make of the book is so that a straight pass-through happens, or almost a straight pass-through happens, it actually doesn't impact the profitability very much. And again, a track record of some of these names in India is pretty good in terms of passing on rates. Second thing is, this is not something which is new in terms of expectation of a rate hike. Well, IL&FS was new, but expectation of rate hike is not exactly new. Okay. And this was building up, and banks, NBFCs over the last 12-18 months have elongated the funding profile in India and elsewhere. So I don't worry too much of this snowballing into something really drastic.
Okay. What about you, Saurabh? You had originally expressed a preference for housing finance. Which leg of the NBFC would you be comfortable with, and which would you be uncomfortable with?
So I think we'll stick with our preference for HFCs, especially those where I think the books are seasoned and which are more exposed to the individual mortgage, either salaried or self-employed. I think that preference kind of remains. And also in HFCs, you have to remember, on the back book, you're essentially borrowing fixed rate substantially and lending on a floating rate basis. So back book ALM kind of plays out positively in a rising rate scenario. It's only the incremental loans where the spread compresses, but back book should be positive. Okay,
which brings me to the other sector that you're tracking very closely in India, property. What's your sense? I mean, we actually got a spate of upgrades, or at least, some kind of an improvement in outlook from a bunch of your peers. Today, Citi, alerted us that they want to look at, the housing sector or the property sector more closely, more home builders. Macquarie said so, and a couple of days back, Morgan Stanley had in their improved outlook, Soba, Prestige Estates, Oberoi Realty, all of them up there in their list. What's your call? Is it time to upgrade real estate?
So, Lata, what we are seeing essentially in the market is no longer falling, it is static. Obviously, improvement will be out 1 to 2 years, but within that, the listed developers are essentially increasing market share in almost all cities, and that's backed by the brand and the track record on deliveries. And as the market picks up, we believe that some of these builders will essentially gain disproportionately versus the other players. And the other thing is the back book of a lot of these developers, which were essentially a lot of low margin projects, have kind of moved out. So one would hope that there will be some margin improvement as well over the next 2 years.
So short point, you've also upgraded them?
Yeah, so we have a buy on a few of them.
Okay. All right. A final question to you, Harsh. In fact, to both of you. I'll begin with Harsha, though. The market regulator yesterday said that large Indian conglomerates or large Indian companies will have to borrow 25% of their requirements from the bond market. How do you see this evolving? Will this be a positive for NBFCs and the others who handle bond markets, mutual funds? Who are the winners and losers of this rule?
Well, see, to me, the bond market borrowing, ultimately, it's a matter of market maturity. As the GDP per capita goes up, as the deposit per capita starts moving up, ultimately, at some point in time, the debt capital market and equity capital markets become much bigger part of financial system. So to me, this is one way of trying to accelerate that process in India. And to what extent it happens, legislation is one thing, but to what extent do corporates actually go ahead and do that, and what timeline, how do they define the total exposure, and so on and so forth, remains to be seen. But to the extent there is a genuine need for alternative sources of funding outside of banks, and if they get better pricing, if they get better terms, I think that's great.
No, Harsha, if I may interrupt.
I take by fiat with a bit of pinch of salt.
No, I agree with you. I'm asking you this question because you have seen how the corporate bond market evolved in various countries, and so you are better placed to, delineate this trend. It could not have come at a better time in India because banks are weak. Corporate lenders are on their knees, and the NBFCs have used this period to ramp up their own sources of funds and their kitty. It probably has come at a right time. Do you see, for the longest time, India has been saying we have to evolve our bond markets and nothing much has happened. Will this work?
That's what, it remains to be seen. See, ultimately, why a bond market, any corporate goes to a bond market is because they get better terms and better pricing. In this context, just because they have been told to do it, will it lead to ultimately better terms and better pricing in bond compared to a loan market? Then yes, they will do it. If they don't, then they won't.
Okay.
As in, they'll try to figure a way out around it. So to me, that's why I'm saying, by fiat may or may not work. It is always market forces which are dominant.
It would better be a market pull. Your thoughts, Saurabh, on this, and any idea of assessing winners and losers because of this fiat, as Harsha says?
So, Lata, what we've seen over the last few years was rates were falling and bond market was far more competitive in giving at least large corporates, better rated corporates loans versus the banking system. As rates rise, we were expecting some re-intermediation back by banks versus the bond market, which could have helped growth for corporate lenders. So to that extent, if this rule comes out, it will be slightly negative as the borrowers will be forced, irrespective of the rates, to borrow from the bond market. Having said that, the overall ruling of 25%, if you look at the difference, I mean, the share of bond market to overall lending is essentially around that. So, I mean, there are mixed changes, but this is not something which is probably going to be very dramatic.
Okay. Well, we'll have to ask the rating agencies as well whether the markets are ready for this. But thank you very much, Saurabh and Harsha, for coming over to our camera and speaking to us. Thank you very much for joining us.
The Nifty and the Sensex are trading in the green, and the reason is that we have seen a bit of pullback when it comes to the Bank Nifty. Even the MidCap index has shown a tad bit of recovery because right now it's sitting with a cut of around 140 points. If you look at where the recovery is coming from, take a look at the Axis Bank. We have seen quite a bit of sharp recovery when it comes to Axis Bank, and even if you look at the ICICI Bank in the last hour or so, we have seen a bit of movement when it comes to the ICICI Bank stock as well. And SBI also now trading flattish, but it had made an up move on that as well. well. Titan is another stock. Remember, earlier in the day it had seen a cut of close to 3%. It has recovered most of its losses and now trading with a cut of just 0.5%. And Sun Pharma as well. Now that one has suddenly moved up. That one is sitting with a gain of 1.5%. And the move in the banking stock is something that you can see in the broader markets also. So pick up a Union Bank. That is now up around 5%. Muthoot Finance has been active since the morning, and that one is sitting with a gain of around 4%. Bank of Baroda had seen quite a bit of cut yesterday. It was down about 16% after that announcement of the three-way bank merger came in. But today it is seeing a tad bit of recovery, 4% higher on that one. And a lot of reactions coming as a result of the SEBI meet yesterday. So one of the decisions was that the commodities trading would be open to the foreign investors as well. And you can see the reaction on MCX given this higher business opportunity. There was a positive brokerage action from Motilal Oswal also on that one. So that one is moving higher by around 4%. And other than that, these oil marketing companies are also doing well. So BPCL, MRPL, ONGC are trading higher. So that one is also a bit of positive. But I think we can go across to Surbi, who's right now chatting with the JP Morgan team. She's in conversation with Panakan Parikh, the metals analyst at JP Morgan. Surbi, over to you.
Thank you very much for that. Metals and energy, may I add. So there's lots to discuss with Pinakin because, we are in this environment where there's a specter of global trade wars. What does that mean for commodities? Well, let's ask Pinakin himself. Thank you for taking out the time, Pinakin. That is really my first question. We have been in a zone of pretty impressive prices, particularly on the steel side. What does all this trade war reality now mean for the metals complex?
Sure. So basically from a trade war perspective, the impact so far has been more on the financial side. So those commodities which are traded by financial investors like base metals have taken it on the chin. YTD base metal prices are down between 20 and 30%. The steel complex, which is more driven by physical demand and supply, has held out to be much better. We have seen steel prices hold out, steel spreads are at decade highs, and even within the noise that we have seen companies raise prices. So on the ground, the environment so far is much more positive for the ferrous side. For non-ferrous, we need to wait and see once this entire noise settles down as to what is the actual impact on demand, because the fact is that YTD, there has been a very large amount of destocking we have seen across the base metals complex.
In our off-air interaction, I think you made a very interesting point. I thought that was the headline. Can steel head the graphite way? Because we know what's happened with graphite electrode prices, but are we really entering such a strong, super strong steel cycle, irrespective of what happens to global demand because of these trade issues?
See, steel cycle, the upcycle which started around 18 months back was essentially supply driven. So China cut the capacities, they cut production, and at the same time demand ex-China went up. Chinese steel exports went from a run rate of 100 million tons a year to 60 million tons a year, and that pushed up prices. So going forward, how spreads hold out will be a function of the incremental production cuts or production increases we see in China. My colleagues in China at JP Morgan do highlight that the winter production cuts are still on. We are still going to see production cuts. So from an India perspective, what I would look at is, even if current prices hold out and even if current spreads hold out, it is probably the best earnings environment we have seen for steel companies in India over the last many years. You throw in the rupee depreciation, you throw in very strong domestic demand, and the fact is that there is no new supply on the horizon, at least for the next 2 years.
Does that mean significantly elevated stock prices?
See, from a stock price perspective, what has happened with steel stocks globally is that investors do not believe that the current margin environment is sustainable. So globally, steel stocks are trading at low single-digit PE multiples. What we are seeing in India is essentially the stocks rallying because of earnings upgrades that are happening on the street, consensus earnings upgrades. My view is that eventually the markets will recognize that you don't have new steel capacity coming through, and you should also see a multiple re-rating happen. So yes, for the steel stocks in India, we do see good times ahead.
But where does this whole IBC resolution and this fight for good steel assets then come in? For instance, I mean, what would your view be on a Tata Steel or a JSW Steel, given the fact that some of these bigger companies are in the fray for paying top dollar or top rupee for the IBC assets?
See, the way we look at IBC is that there is a book value of those assets, which is basically the debt that you have to pay for, and then there is a replacement value of those assets. The fact is that in today's India, if you want to set up a greenfield steel plant, the land acquisition process can take years. The rupee depreciation means that the greenfield project cost has gone up substantially. So we have not viewed the bids as outrageous. Yes, we would like to see a bidding war being averted, but at the end of the day, if you combine the India domestic macro environment, which is the demand is improving, the lack of new capacities, and the higher replacement cost, in our view, the IBC assets are good assets to acquire, as long as you do not massively overpay for them in the current environment.
Are the current bids rational?